Welcome everyone to the second annual CFO Dimensions conference. We're thrilled to have you here. We've got a great program in store. Can't wait to get to it. And what I'm going to do is tell you a little bit about what we're doing here, talk a little bit about the agenda, and of course introduce our keynote speaker, and I can't wait to hear his presentation myself. But I'm going to get started by addressing a question that I get asked all the time, which is, why did we build Proformative? What was the motivation? Now, as Greg just mentioned in the introduction there, I've been a CFO 4 times. I've been in finance 20 years. And in 2005, I was CFO of a company that was backed by one of the larger VCs in the country. And they invited me to a get-together of CFOs. It was not much unlike this, except a smaller venue. And I walked into a room with about 40 CFOs. And I was immediately struck by what a waste it was that here were 40 people doing precisely my job, and yet outside of this coffee once a year for 2 hours, we did not exist for one another. And that seemed like an awful waste of knowledge. Now, at the same time, I was an avid motorcyclist, and I belonged to a number of online motorcycling communities. Now, this was way before Facebook or any of the social platforms were available. So this was an email back and forth, question and answer sort of community. And it was a uniquely simple and convenient way to exchange information and gain knowledge. So folks who are my age in the room will recognize this analogy. I had what I refer to as my Reese's peanut butter moment, where you have these two things barrel into one another and you have some sort of interesting idea. Probably not as good as the Reese's peanut butter cup idea, but it was the idea of bringing a social community of CFOs together online to see whether or not we could help one another out. And as it turned out, we did that. We got those 40 CFOs online. And it ended up being the most useful business tool I have ever had. I mean, McKinsey, bless them, on their best day, cannot give you the advice and insight of 40 CFOs. That just doesn't exist. Nobody has that. And yet we had it in this little community on tap 24/7, and it was free. That was an amazing thing. Now, our vision for Proformative was to do that times, at this point, approximately 15,000. So we're about 15,000 times bigger than that community was right now, and we're growing quickly. And our goal was to build an online, noise-free, peer-based community for the office of the CFO. Each of these elements is critical. Online, number one, we live in an online world. We have to communicate very quickly. And in order to make an online community work, or make a community work, it has to have clear and open lines of communication. So being online was a must. Noise-free. For those who have spent any time on the Proformative platform, you know there's no ads. There's no selling or self-promotion in the community. It's a uniquely quiet, high-quality place to learn from peers. And it's all focused on the office of the CFO. So that's CFOs, treasurers, controllers, VPs of finance, all the way to bookkeepers and financial analysts, although it's primarily senior executives. About 85% of our user base is director level and above. So we've wrapped all of that up into this great online community. And I'm going to give a quick look at a couple elements of this community for those who are more familiar perhaps with our events and not so much with what we do online. We ask and answer questions all day, and the company actually does none of this. We're a platform like Facebook. So Mark Zuckerberg is not there answering people's queries on Facebook. It's peer-to-peer. We're the same way. So this is one of my favorite questions asked recently. I'm struggling to deal with my CEO who has questionable expense reports. I don't know a CFO who hasn't dealt with that. That's a very typical operating day-to-day question for a finance executive. What do I do here? Now, this was asked anonymously. About 5% of the questions on the site are asked anonymously. The majority have a name and a face attached to them, but we do enable this. You can see here that this question was asked fairly recently. It has almost 8,000 views already. So we're a very heavily trafficked site. And what's good about that is your question, if you happen to ask one, will be answered, and it will be answered by a lot of people very quickly. And you'll see here, interestingly, the first person to answer was the CFO of JDSU, which is a publicly traded Fortune 500 company. And we've got Ken Goldman, who's the CFO of Yahoo, participating. And we have literally tens of thousands of CFOs on the site participating, and tens of thousands of corporate controllers and treasurers, et cetera. So this is a resource that's simply unique. And as I mentioned before, it's completely free, which is fantastic. A couple other examples of what you might find on the site. Here is a CFO asking for benchmarking for audit fees. We get a lot of these questions about products and service providers. Here's a career-based question asked by a VP of Finance. Should I go the COO road or the CFO road? So these are very common interactions, and it's everything from technical accounting to dealing with your CEO and everything in between. Something we've just added, less than 2 months ago, we launched what we call the Exchange. If anyone here has ever used Yelp or Amazon, this will be very familiar. For about 4,000 products in 37 categories, everything from ERP and budgeting and forecasting systems to audit services, tax preparation, et cetera, you can find peer-based reviews of these products and services. So this is something that folks outside of our functional areas don't realize. But the Office of the CFO controls over $3 trillion of spending in the U.S. every year. That is an incredible amount of money, and it's an incredible amount of responsibility for everyone in this room. And yet there are very few unpaid resources that you can tap into to find out what platform should I be looking at, what service providers should I use. Well, in this case, you're able to hear directly from peers. These reviews, once again, they don't come from us, they come from you. They're all heavily vetted. They have to be from finance, accounting, treasury, or related practitioners. And we actually look at the company of the person writing the review, and we make sure they're not in the ecosystem of the product or service that they're reviewing. So this is an incredibly valuable and useful resource. It's something we've just added to the site. So it's a great place to learn about all sorts of things, operational purchases you're making, et cetera. That's the Exchange. A few quick stats on Proformative. We have been around for only 3.5 years since we launched, 4 years if you include when we incorporated. In the last 12 months, we've had over 600,000 unique visitors to the site, and a multiple of that in terms of visits. That's up actually almost 4 times in the last year and a half, so we're growing very quickly, which is great. Over 60,000 users have visited the site over 25 times. In fact, over 10,000 users have visited the site over 200 times. I don't even think we're that good, but clearly we're doing something that's helpful to our user base, and that peer-to-peer interaction is really working for folks. Over 20,000 community members have asked questions or contributed answers, which is fantastic. It's a very active, vibrant group. And with the recently launched Exchange, we have over 500 product and service reviews, and that's growing very quickly. So why does a company that's so focused on the online world do something like this, a live event? And we only do 2 live events a year. We have a finance technology conference that we do in the spring that's going to be in Las Vegas this coming year. And we do this finance strategy conference in the fall. And we did this in Chicago last year and now in New York. And we do it because sometimes it's more effective to be offline and to have face-to-face interaction with subject matter experts when you're trying to learn. Rubbing elbows with your peers, very important. What are they doing? How are they doing it? What are they seeing in their marketplaces, et cetera? And making new and valuable connections. And these are all things that we encourage. I think you're going to get plenty of all of the above today. And that's going to be brought to you by these folks. We have a fantastic array of highly qualified speakers, starting with our keynote speaker, and I'll get to his introduction very shortly here. But it's an amazingly talented and experienced group. They're expert at what they do, whether they're finance practitioners, and many of these folks are finance practitioners, or subject matter experts who have background in finance. It's an incredible crew, and we really look forward to hearing from them today. And we'd like to hear from you today as well, and we'd like to encourage you to interact with all of the speakers. Every session today, with nary an exception, I believe, has a Q&A component at the end. And we'd like you to bring your questions. Feel free. These are smart folks. They've got lots of experience, usually many decades, and they want to help you answer your questions. So whether it's at the end during the Q&A or immediately after, if you want to approach them at the end of their session, exchange cards, make a connection, please do that. So bring your questions, be inquisitive all day. I couldn't do this without a shout out to our sponsors. This is a big event. It's not easy to put an event like this on. It's certainly not inexpensive to do it. We could not do it without the support of these wonderful sponsors. I'd like to specifically point out our diamond sponsor, SAP. We were approached by SAP last year when we did our initial CFO Dimensions, and they had a vision for a wonderful peer-based senior finance executive conference, which we also wanted to put on. And together we've built a great partnership around CFO Dimensions. Also mentioning Intact and NetSuite, our platinum sponsors. And without the support of all of our wonderful sponsors, we couldn't do this event. So we thank them very much and appreciate their support. A few items of housekeeping before we get started, just to let everyone know how the day is going to lay out. Number one, there are some folks here who are maintaining their CPA accreditation or other accreditations. We're offering CPE credits today. Check in at registration to make sure you get your documentation, and then check in at the beginning of every session. There is a tip sheet that you received when you registered. If you have questions about CPE, we've answered some of the core ones on that tip sheet. On the back of that tip sheet is a survey. It's a corporate finance leadership survey. We would love for you to take 3 minutes and fill that out. If you drop that by the Proformative booth in the expo area by 4 p.m., you'll be entered to win a great MacBook Air. If you're social in nature, and I know this is anathema to many CFOs, but if not, please use hashtag CFOD13 to talk about the event today and share what you're seeing. And we also have a short survey after each session, and we use that to gauge how well we're doing. Was the information good? Was it presented well? You would be doing us a great favor if you spend 60 seconds after each session and drop that with the room monitor. One other thing of note, I'll show you this little light, if I get this right. If you see this today, that means that's a Proformative employee. They're here to help out all day long. So feel free if you have any questions at all, and I'll be wearing mine. We want to make this as easy and pain-free as possible. So any questions at all, just approach one of our folks and we'll get you taken care of. A quick look at the agenda. It's a busy one. We have 5 breakout sessions. We're starting with the keynote this morning. We have a number of opportunities to network, to speak with the sponsors, which I encourage you to do throughout the day. We've got a fantastic CFO panel that's going to be hosted by Dr. John Percival, who's a finance professor at Wharton. And then we have an awards presentation for CFO of the Year, as nominated by our user base, and then we'll have a closing reception. So we're looking forward to this. There's a lot going on, but there are a number of breaks, and I think it's going to be a great, fun day. So without further ado, it's my honor to introduce our keynote speaker. Our keynote today is Tom Conforti. Tom is an EVP and CFO of Wyndham Worldwide. Now, Wyndham Worldwide is one of the largest hospitality companies in the world. In fact, if measured by units owned and under management, they are the largest. They're also the largest owner of timeshare properties in the world, of which I've used myself, and they are fantastic. Tom has done an amazing job as the finance leader at Wyndham Worldwide. He's going to be talking about that in his presentation, so I won't steal much of his thunder here. Previously, he was CFO at DineEquity. Now, DineEquity owns the IHOP and Applebee's brands, and Tom worked his same magic there. So wherever he goes, he sprinkles some pixie dust and shareholder value goes through the roof. Prior to that, he had a number of finance and strategy roles at the consumer products division of Walt Disney. And when my family comes out this evening to spend the weekend, we're certainly going to be dropping some dollars, Tom, into your old company. And he started with various finance roles with CBS and PepsiCo. Now, a couple of things to note before we get Tom up here. Number one, prior to that, he was recently voted Best Investor Relations by a CFO by IR Magazine, which is a great honor, and congratulations on that. And this is what happens when Tom joins a company. So since the depths of the recession downturn in 2009 until today, Wyndham Worldwide has gained more value than any other company in the S&P 500, which is incredible. And this is actually not the first time he's done this for one of his companies. So wherever Tom goes, value gets created, and it is genuinely led by the finance organization. So sometimes it's a great new product that comes out. Of course, every company is based on the efforts of all of its employees, but where Tom goes, the finance organization really leads the charge, and this is the kind of shareholder value that's created. Now, Tom has an incredible journey that he's going to tell us about, and it actually starts with a film clip that most folks here will recognize, and this is emblematic of Tom's journey. So we'll get that going, and then we'll bring Tom up on stage.
Hello. My name's Forrest Gump. Do you want a chocolate? I could eat about 1.5 million of these. My mom always said life was like a box of chocolates. You never know what you're going to get. Those must be comfortable shoes. I bet you could walk all day in shoes like that and not feel a thing. I wish I had shoes like that.
My feet hurt.
Mom always said there's an awful lot you can tell about a person by their shoes. Where they going? Where they been? I've worn lots of shoes. I bet if I think about it real hard, I could remember my first pair of shoes. Mama said they'd take me anywhere.
Morning, everyone. John, thanks for that really overly generous acknowledgement. These types of successes are driven by a larger team, but I appreciate the acknowledgement. So when John and I were going back and forth about what I might speak about today that might hold your interest for a half an hour, we thought, I looked back at my career and I thought to myself, maybe I can talk about my involvement in business transformation. And the reason that we're showing the Forrest Gump clip, other than the fact that I like the movie, is the fact that when I look back at my career, I tend to think of myself as a Forrest Gump, CFO of Forrest Gumps. And the reason I do that is because it seems that every company that I've been a part of was either underway with some level of transformation, or when I arrived, the company needed to be transformed. So I've always felt like I'm the Forrest Gump of CFOs. I've been very fortunate. So let me take a second and define transformation, because this presentation is going to be about transformation. I looked up the definition of the word transformation last night, and it's a simple definition: a marked change, either in appearance or character, and usually with a favorable outcome. So I want to share something with you that happened last night as I was preparing my comments for the meeting that luckily turned out to be not a transformative event. I was sitting after dinner with my wife, and I was looking at television with her, and we were in a dark room, and I felt something flutter by. And I thought to myself, gee, that's a big moth. And so some time passed, and I ignored it, and I thought, it can't possibly be a bat, can it? So my wife has the same sort of sensation. She sees something flutter by her. And we turned the light on, and we found out we were joined by a bat in our living room. And so my wife ran upstairs, locked the bedroom door. I showed up with a hat on because I didn't want it to get caught in my hair. I had the oven gloves on because I was told if you need to pick up a bat, they'll try to bite you. And so I actually ended up giving up on that. But you know, bats for me have always had sort of an otherworldly sort of feeling to it. And so then I thought to myself, how appropriate. Here I am about to talk about transformation. There's a bat in my house. And so I hope tonight that that transformation doesn't take place, that bat doesn't turn into Count Dracula, and we're greeted accordingly. So that was transformation that didn't take place, and frankly, I'm happy about it. So let me just kind of summarize my experience with transformation. Transformation in my career has happened a number of different ways, and I'm going to talk about 3 specific examples. One was an operational transformation, another was a business model transformation, and the third at Wyndham is a combination of a transformation based on a change in capital allocation and also a business model transformation as well. So I think the important takeaway in transformation, it can happen in many, many different forms. And so really, what does it take to experience transformation? And in my experience, there are a few things really that matter. First, the conditions have to exist for something to be transformed. There has to be a way that business is being conducted, and there has to be a better way that that same business can be conducted. So conditions have to be precedent for change. Really importantly, and we should never forget this as finance professionals, transformation only takes place when you have a willing CEO, a willing and eager CEO. And I've been fortunate in my career to work with CEOs who are both willing and eager. I think transformation has to take place when you have a clear objective in mind, and you'll see what that objective is. It could be growth of the business. It could be improved ROIC. It could be improved cash flow. So the objective needs to be clear, it needs to be powerful, and it needs to be well communicated. In my opinion, to achieve a transformation of any magnitude, one has to possess a strategic orientation. But this is very important, and it gets to John's earlier point. It's a strategic orientation enhanced by the views of others. And I'll share some experiences that I've had in my career where transformation took place and was prompted by the views of others and carried out by a group in the company. And then finally, and there's no getting around this, while finance can play an important role, long-term business transformation takes place only when it's coupled with outstanding business execution. And so I've been fortunate that in every company that I've been a part of, while we've transformed the company, along with that has become stellar business performance. And so in my mind, those are the key elements of what it takes. I was going to quickly touch on my journey. I think John covered it in sufficient detail. I will point out a couple of things, though. In my time at Pepsi and Disney particularly, there was a culture of finance playing a key role. And so at a very young age, and I think I graduated business school at 21 or 22 years old, and I joined Pepsi, I learned very quickly those things that are viewed as value-added functions for finance executives, and those things that you have to manage but don't need to spend as much time on. And so that was reinforced when a bunch of Pepsi finance executives moved over to Disney at the beginning of 1990 and slightly before then. So it's important to understand what counts. And I also spent time as a GM in a number of businesses. And I think as a finance executive of a public company, my ability to align with my operating team and to deal effectively internally and externally was significantly enhanced by my time as a GM, particularly at Disney. There are a few core beliefs that I have that I just kind of want to rattle off. One is focus on the big picture, but sweat the details. You know, I've encountered a bunch of people in my career who like to focus on the big the big picture, and leave behind the details. And I've seen a lot of good strategies in my life turn out to be bad decisions because the execution wasn't there. So it's a combination of strategy and execution. You'll hear this throughout all of my experiences. Cash is king. And I will share that with you firsthand on how we made a decision along the way to affect accounting earnings to be able to improve the economic profile of the business and the cash flow generation of the business. So cash definitely is king. And in my mind, decision-making has to be made with the following frame of mind. Every time you're faced with a decision, it's our obligation to make the right call and try to make the right call each and every time and not be influenced by other agendas. And so those are three sort of personal philosophies that I kind of hold dear. So I think I'm going to start my journey here, and I'm going to start it with my time at Disney. Now, this is a very embarrassing picture for me. You know, I don't look good with Mickey Mouse ears. My ears are big enough, and they conflict with Mickey Mouse ears. But about 1989, I had a visit from a friend who had just joined Walt Disney as CFO of the movie and TV business. We had been colleagues at Pepsi. And he and his wife had come to the East Coast, and we were having dinner, my wife as well. And he said, you know, you should come to California and work for Walt Disney. Now, I was firmly committed to Connecticut. My family lived in Connecticut. I held public office in Connecticut in a limited capacity. And so I thought, you know, I don't think it's in the cards. He said, no, come out. You'll see my family. You'll spend some time with us. It's fun. Because there was a job at Disney that was a peer for this job. And so my wife urged me to consider the trip to California. It would be nice to go to California. And so I had never really been to California before. And so I took the trip expecting nothing. And here's what I experienced when I reached the gates of Walt Disney Studios. I experienced incredible, amazing, ambitious people. The pixie dust is definitely real at Disney. I don't know if they put it through the vents, but I will tell you the pixie dust is definitely real. And I remember getting a holiday card with a picture of Mickey Mouse and the standard characters on it, and I thought, I got to be a part of this. They have world-leading brands. When I visited, that was obvious. And you could just have the feeling, this is the late 80s, so Disney had been underway in its renaissance as a company. You could feel, it was palpable that something very good was happening. So my wife, who had urged me to be open-minded about the trip to California, when I came back and was overwhelmed by the experience and suggested that, how do you feel about California, realizing that she was carrying our second child, her reaction was quite different than what I expected. Her reaction was, are you kidding me, really, California? And she never thought she would ever leave Connecticut. She thought she was going to be in prison there. So we ended up making a decision after much give and take to move to California. And I joined Walt Disney as the CFO in waiting for the Consumer Products Division. And so let me take a minute to describe what the Consumer Products Division was. I joined in 1990. There were three divisions of Disney at the time: filmed entertainment and TV, the theme parks business, and then everything else. And I was the CFO of everything else. And you can see the different product. Anything that had a Disney character on it, we licensed. Toy companies, apparel companies, any conceivable use of consumer products, we licensed. So it was multiple products within mostly a licensing framework. It was globally dispersed. About half of the income came internationally. Markets like Japan and Western Europe had long traditions of Walt Disney product. You'll see in the transformation, much more took place. The retail scale of the business, believe it or not, what the consumer spent on $1's worth of Disney product, as opposed to the theme park business and the film business. Over time, our business, the scale of our business was greater than either of those other businesses, simply by the sheer transaction activity that was taking place. And it was underway with dynamic profit growth. And so this is the company that I joined. Very exciting things happening, but still a business waiting for transformation. And so I want to talk about what I observed to be the drivers of transformation in consumer products, the drivers that took a business that was earning $150 to $200 million of operating income, and at its peak earned close to $900 million of operating income. And let me tell you, managing a fast-growing business like that over a long period of time is exhausting. So here were the drivers, in my opinion. Amazing people. My lesson at Disney, more than any other lesson, was it really is about the people that count. If you can hire and inspire great people to do great things, you could achieve anything. So fired up leadership was definitely a part of it. New business development. We had our characters. We wanted to take advantage of our characters' popularity in every single way possible. So in the period of time that I was there, we opened up a retail concept. We got into the interactive games business. We built a magazine and book publishing business, and we got into the catalog business. So business development was key. Let's take our characters and find ways to take advantage of those characters. We expanded even further globally. We further developed our well-developed markets, and we expanded in areas like Latin America and Asia. And then probably the biggest driver of business unit transformation was the introduction of new characters. Historically, the company just concentrated on the standard characters, Mickey, Minnie, Pluto, Goofy. It's been a while. My kids are older. But in, I think it was 1992, 1993, the first of the filmed entertainment properties, Little Mermaid, was introduced, followed incredibly by one success after another. So we not only had our standard characters now that we could run through this consumer products machine, but we had other groups of characters, filmed characters. We introduced Winnie the Pooh in a major way. And so one of the key drivers of the business unit performance was this introduction of new character groupings. And so, you know, what did it all translate into? It translated into a business that was growing operating income at a compound annual growth rate of around 25% a year for about 7 years, which is not easy to do. It certainly isn't easy to keep the momentum going, but we were quite fortunate that we were able to transform operationally this business in ways that were quite memorable. So what was finance's role at Disney? It was never stated publicly, but I think the goal of the leaders of Disney were to try to combine creative genius with commercial advantage. And so the Tinkerbell represents creative genius, and the dollars on the scale, in scale, represent the commercial objectives of the company. And it was really up to the finance team to play a very broad role in the organization, because creatives don't necessarily translate into commercially oriented people. So the roles that finance played were broad and important, operating roles in many respects. And it was important that finance played the role to support these initiatives, because when you have a company that has so much momentum, you want to keep that momentum going and not be a block to momentum. Be more of a yes than a no as a finance executive, and that was an important learning for me as well. So at my time at Disney, you know, what did I learn about business transformation? First and foremost, it really is all about the people that you travel with. If you have a talented and inspired group of people, you can achieve a great deal. So as you're thinking about business transformation in your own businesses, look at who's on the side of you, look who's ahead of you, look who's behind you, and make sure you have the right people who can carry that journey with you. I made this comment earlier. You have to work incredibly hard just to keep up in a fast-growing business. We couldn't hire talented people fast enough, the rate of growth that we were having. So if you're fortunate enough to be in an environment that's growing rapidly, keep in mind that it's going to put on your track shoes, and you're going to have to keep pace, because the pace will be never ending. And then an important lesson that I took from my time at Disney that I carry with me throughout my career is that intellectual property businesses, fee-for-service businesses that don't require a lot of capital, are the best businesses. And you'll see that I've taken that personal belief into each and every job that I've had since. So that's the Disney story. And after some time at Disney, and then having left Disney and spending some time in Southern California, I ended up joining IHOP, as it was my first public company CFO role. And yes, those are pancakes that my chin is resting on there, a big stack of pancakes. And IHOP was a very interesting story. When I was interviewing with IHOP, the CEO said to me, she was recently appointed CEO, you know, one of the first things I want you to do is to look at the business model, because they had a unique way to franchise, and I'll describe that to you in a second. And because she said, I'm not sure it's the right model that we have. And so I said, okay, I'll keep that in mind as I joined the company. First day, I get a call from a guy. I didn't know who he was. It was a call from a shareholder at the time who had filed a 13D. Does everyone know what a 13D is? Who doesn't know what a 13D is? A 13D is a filing that an investor will make expressing specific areas of interest that he'd like to influence management in. So it's typically a sign of a more activist intention than a normal relationship with an investor. And I had this call from this investor on my first day in the job, wishing me well, telling me that he had checked me out with people that we both have in common and that I had passed that individual's test. But that he was a little frustrated with the way management was handling the company. So this is my first day on the job, and I'm thinking, oh man, what did I get myself into here? And the basis of his 13D had 2 points. Number one, he didn't like our business model, like our CEO was questioning whether the business model was the right business model. And two, he wanted us to monetize our balance sheet and return all the cash to shareholders. And so, a little self-serving, don't you think? So I said, look, I'm new here. I don't even know where the pens and pencils are just yet. But I promise you that, that we will consider your points. And if we agree with you, we'll let you know and we'll change things. And if we don't agree with you, we'll tell you we don't agree with you. And so that was a very interesting way for me to start my job on day one at IHOP. But as I look back at it, when I talk about what needs to exist for business transformation, every fundamental element that needs to exist existed when I joined IHOP. Number one, the business model definitely needed to change. And so let me describe what the business model was. One of the advantages of franchising and intellectual property-based businesses is you use other people's capital to build brick and mortar. Well, IHOP didn't have that model in place. IHOP employed its own balance sheet to build restaurants, and in addition, to sit on the leases that the landowners had, the landlords had, because it felt that they could earn additional income by sitting on the leases and then marking up the leases to the franchisees. And so it was an interesting construct if you think about it. You know, it enabled IHOP to grow to a certain level, but you know, it did violate some of the real benefits that one derives from an intellectual property-based business. And so the claim that the investor made and that my CEO wanted us to consider was, is this the right way to be in the franchising business? I think at the time, we probably had 1,300 restaurants. And instead, what was being proposed is what every other fee-for-service franchising licensing business is let the other party take the financial risk of CapEx and brick and mortar, and you be a provider of intellectual property. And so it seemed pretty sensible to me. And when we spent some time within the first month on the job, when we spent some time on it, we concluded that in this particular case, the investor was right. And you know, luckily, I had a CEO who was a newly minted CEO who thought, I agree, this is the right thing to do. One of the issues was that the chairman of the board, who had been the CEO for about 20 years and had constructed this model, didn't quite see it that way. So in my first month on the job, I'm up in front of the board with the chairman sitting there saying, I think we need to step away from this business model and that the other guys are right. So the board was a little surprised by our conclusions, asked us to come back after a couple weeks and present our final point of view. We did a little more work and we came to the same conclusion that the business model had to change. In the interim, the chairman, knowing that that was what our proposal was to the board, decided to leave the company. And so now the CEO and I were faced with the direct involvement with the board which had been accustomed to the chairman of the board leading the direction of the board. So this is all in the first month, guys. I kid you not. This couldn't have happened. I couldn't make this story up. And so one of the other things that we concluded in this process is that we were going to have to take a hit on accounting earnings. And but the trade-off was we were going to move from being a net user of capital each and every year to a significant generator of free cash flow. And that's what investors wanted us to do. And that we thought that was the right thing to do. And so we went forward with this decision. We reduced our earnings per share. I think it was between 15 and 20%. We talked about our ability to sustain free cash flow at a much higher level than had been the case historically. And it was amazing what we saw. We saw a bunch of investors leave and a group of investors come right in, and we didn't skip a beat. And the stock never declined. And the stock just started an onward climb up and up and up. We also described what we would do with the cash, and part of what we would do with the cash is to give it back to shareholders, share repurchase because the stock was undervalued, dividends because none existed, and we didn't know, since we had an intellectual property business now with no CapEx requirements, we didn't know what we would do with the cash. We didn't have to invest it in brick and mortar anyhow, so we had a bunch of cash, and everybody was happy, and it began a terrific climb up. Combined with that was a transformation of sorts on the operating side. The CEO, who I had the good fortune to work with, knew the restaurant business and knew how to manage franchisees and drive momentum in the system. So the combined business model change and the operating improvements that we made led to significant share price improvement. I do want to say one other thing. We also told the activist shareholder we weren't going to monetize our balance sheet, and we gave him reason. But the real important message here was not that we had to agree with him on everything, but that we respected his opinion and we were going to be responsive to his inquiry. And so we said yes on the business model. He said, hooray. And when we said no on the cash, he said, I understand. You're a great management team. Go forth and prosper. And so what happened was over a period of a couple, 3 years or so, our stock price tripled. All of this was done in spite of the fact that we had lowered our accounting earnings up front. So what did I learn from my time at IHOP? Number one, I learned that activist shareholders aren't necessarily bad guys. Activist shareholders typically are pretty smart guys, and their input can be valuable. You be receptive to their input and be responsive to their inquiry. You don't have to agree with everything they say, but communications blackout for any professional relationship doesn't work. And so that was an important learning for me. I like it because activist shareholders kind of keep me on my toes because they're really smart guys. Second thing I learned, and this is really important, you'll hear it again, cash is king. Accounting earnings are nice. People like accounting earnings. It's nice optics. But people prefer cash. Cash can make you do things that accounting earnings can't. And this was an interesting quote from our investors based on the changes and the hard decisions we made, is you get the investor that you deserve. So if your approach to business is not to find ways to run the business in a way that enhances long-term shareholder value, then you're going to end up with investors who may not realize that. And that if you make the right decisions, you'll end up with tremendous supportive investors. And during my time at IHOP, I was fortunate that was the case. So the final step on my journey was the decision to come to Wyndham Worldwide. So I get a call from a recruiter that I knew for the longest time. I'll try to get done in 5. He said, how do you feel about New Jersey? Now, I think at the time I was in Santa Monica at the beach, you know, having a meal out by the ocean. And he said, how do you feel about New Jersey? I said, well, my wife's from New Jersey, so I can't hate it too much. And, remember, I grew up in Connecticut, so what do you got going? And he said, you just come and visit this company because you're going to meet a CEO. He's an extraordinary guy in a culture that you will not find anywhere else in the country. And so I said, with a sale like that, how can I say no? And so I ended up coming for an interview. I first thought, I wasn't totally familiar with New Jersey. I knew where my wife grew up. I thought it was going to be like on the I-95 corridor, but it was actually in a nice part of Jersey. And I thought, there are trees around here. That's nice. I had spent too much time in California, frankly. And so when I sat with Steve Holmes, our CEO, and he talked about his vision for the company, I thought, this is IHOP Redux. What did I learn? He wanted the company to be more fee-for-service. So again, cash is king. He had initiated a change in our capital allocation policy. In the old days, we would generate all this cash and we'd invest in the timeshare business and we'd have nothing left, really, in available cash for returning to shareholders or M&A. Most of the capital that we were generating went into the timeshare business. He already had repositioned it so that the timeshare business wasn't going to get it. And the other thing I observed is what an amazing culture, what amazing people. Not only are they fired up, but they're really decent people, and I can really work with these people. So I went back to New Jersey. I went back to California and suggested to my wife delicately that maybe a return to New Jersey will work. And she didn't react as favorably this time around as she did the time I suggested we go to California. But we ended up here, and that was great. And let me take a minute to just describe Wyndham. And John covered it. We are the #1 hotel company in the world. If you look at the number of hotels we have 7,400. I think we're #2 is measured by flags. We have about 635,000. We're #2 measured by rooms, 635,000 rooms. We are religiously a franchised business. I think we might have 7,300 franchised hotels and maybe 100 of them that we operate and only 2 that we own. So we are fee for service, and it produces around $300 million of EBITDA. Our second segment is our exchange and rental segment. We are the largest timeshare exchange company in the world, RCI. We operate in a duopoly, and we control 2/3 of the market. And we are also the #1 managed vacation rental company in Europe and the United States, with access to over 100,000 locations. And it produces around $350 to $400 million of EBITDA, a little less than $400 million of EBITDA. And finally, we are the 800-pound gorilla in the timeshare space. It's a business that earns around $600 million of EBITDA. We have 900,000 owners. We have 190 resorts by every measure. And we think that if you take up what other companies are making in timeshare and add them all up, you'll come close to our number. So we are that profitable a timeshare company. And when you look at our company as a whole, we really do operate 3 different segments with a bunch of brands in it and different type of product as well. From a company-wide perspective, we generate well over $1 billion of EBITDA, $750 million of free cash flow. We are a company that we believe isn't well understood by the market. People view us as a sum of the parts of our different businesses and don't value some of our businesses as highly as others. And so that sort of sets up part of what my objective was as CFO when I came in after having understood what the challenge would be before me. #1, I had to establish that we could sustainably deliver significant levels of free cash flow, and that investors needed to hear that and needed to demonstrate that, because that had not been the company's history. And it was easy to demonstrate because of the changes that were already underway. But there was an exciting new transformation taking place as well. The timeshare business is a business that historically you would identify the market you want to be in, you'd buy land, the land would be on your balance sheet for a while, you'd get land use approval, then you would take a couple years to build the resort, And eventually you'd sell it and we'd finance people in the business. And we were evolving to an asset-light form of that. Effectively, we want to take the timeshare business, which is a balance sheet intensive business, and we want to move it to a fee-for-service business. So we've introduced a new concept called Wyndham Asset Affiliation Model, where we sell other people's product. And what that model has evolved to now is a just-in-time inventory model. So instead of investing in balance sheet for a 5 to 7 year period, we're now investing in other people are investing in the project, and we're taking down inventory on a just-in-time basis, dramatically improving the ROIC of this business. So this is a finance-led transformation as well at Wyndham. So evolving WAM is really important. We had to work with the business units to continue to drive growth, because at the end of the day, investors care about growth. If it comes about by reducing the number of shares, that's fine, but they also want organic growth. We had to educate and remove the cognitive biases that people have about the timeshare business. And so much of my time was spent in 2011 convincing people that the timeshare business is all I had to convince them was that it wasn't, I didn't have to convince them that it was the best business in the world, just a better business than they're giving me credit for, because the valuation of timeshare is a pretty low valuation on the sum of the parts. And then finally, we had to articulate our capital allocation plan. I won't go through with that. If you're interested in finding what our capital allocation plan is, we have a bunch of stuff on our investor relations website. And I did want to share with you a tool that we use for those people who are football fans with the imminent approach of football this year. Every quarter, we sit with our board of directors and we look at our company value, the underlying value of our company, by what we call our football field. And we have about 8 to 10 different measures that we use to establish what we believe the underlying value of the company is. And why we use this is because we've been aggressive repurchasers of our stock. And so you want to make sure that before the board authorizes additional share repurchase, that the reason they're doing it has good economic sense. So typically, our share price is below the bottom of the range. And so that justifies continued share repurchase. For any of you who are considering share repurchase, I'd recommend that you use something like this to establish the underlying value of the business, so that your share repurchase activity, because in our case, we spent in the last couple of years around $2 billion on share repurchase. So we need to make sure we're doing the right thing for our shareholders. One of my other roles, because it's such a culture-based company, is in my first month on the job, I was appointed Mr. Count on Me. We have a philosophy in our company that really is a valid and a practiced philosophy, which is we can count on each other, and really the amazing culture that we has helps reinforce our business success. So that's Mr. Count on Me. Whenever someone is acknowledged for having done something good, I show up with a bunch of people and a bunch of noisemakers and balloons, and we acknowledge that person. And the truth to the notion that these types of acknowledgments mean more than money has been proven 100% in my experience here at Wyndham. Although money doesn't hurt either. We try to do both. And then, so all of this performance, all of this change and transformation has led to a change in the amount of cash we generate. You can see the steep trend in free cash flow per share. And as John generously shared at the beginning, since the trough, we have been the fastest growing stock on the S&P 500. But there are other awards we've won. We displaced Marriott as the most admired company in 2012. I hope they're not listening in on me here. But that was quite an achievement for a company that was only 6 years old, that we displaced them as the #1 most admired lodging company in our segment. And we also seek these other awards. These are very important. So what have I learned at Wyndham? And I promise, John, I'm going to close on this. Cash. Once again, cash is the great enabler. I've used this on a lot of investor calls. Cash enables you to transform your business. It enables you to buy things. It enables you to connect with your investors. If your stock is undervalued, It enables you to pay a dividend where you might not otherwise pay a dividend. So I urge each and every one of you that as you think about how you're running your business to keep an eye not only on the accounting earnings, but on cash. Communication is key. You know, if you're doing a lot of change, people get confused. You really do need to communicate what you're doing and why you're doing it, and you can't stop. It isn't like you say it once and everybody gets it. You just have to keep driving it home. And don't try to make it too complicated. Make one point at a time, because in spite of how smart investors are, there's sort of a limited capacity to believe. And so it's better to go sort of one step at a time, and that's what we did, at least at Wyndham. Discuss capital allocation. I can't tell you how many investors have said to me, you're the only management team that actually discusses capital allocation, why you do certain things that you do. And I think if you discuss capital allocation and think that your role as CFO is to allocate capital, I think it translates into a much higher degree of credibility with external constituencies that you want to cultivate. And then finally, culture does matter. And you know, if you're going through a lot of change and transformation, you need a culture to go along with you. It ensures alignment. And so wherever you can, try to create a positive cultural environment. And so I just close with the question, where do you guys want to go? And I'd be happy to answer any questions separately. I'll hang around a bit, John, because John has me on a tight time frame. So thanks, everybody, for listening to me. I appreciate it.